Hello and welcome to the Monday Futures Market Outlook for December 5th, 2011. This is Patrick Ceresna. For those of you that have not tried the eminisource.com trading room, 5-day complimentary memberships are available on the website. As always, we start off with the weekly chart of the S&P 500 going back 3 decades, and we plot an 80-week moving average on there. It does a very good job to depict the bull and bear market cycles that we've gone through. Over the last year, we've had numerous violations back and forth along this 80-week moving average as the market is trying to absorb all the information from Europe and in the broader markets. We currently are trading above that 80-week moving average, which if the market creates any positive follow through above 1300 would give some form of an indication that the market is trending higher. Just to make some key intermarket observations, we saw some important reversals off of in all the key markets. Now this week will be the test. We want to see whether or not they can follow through on that positive reversal. The US dollar bears will need to dig in and hold overhead resistance. If we see a US dollar that bullishly breaks out at the same time as the euro deteriorates to new lows, it could send a ripple effect through the markets and quickly end this little party that started last week. In order to see the treasury bond weakness, commodity strength, and market strength, we'll need to see all these currencies contained. And so long as they are contained, the treasury bonds could continue to weaken, which will allow commodities and equity markets to have a very positive year-end rally. So really what it is we're trying to remain relatively positive on these markets, with obviously a very careful eye on the European situation and particularly euro weakness, which could very quickly turn the tide. When we look at the daily charts of the S&P 500 using the E-mini futures contracts, one could recognize this deep wedging formation that came right into the Fibonacci supports around the 1150, 1170 area, and subsequently has now bullishly broken out on the upside. At this juncture, we believe that this does open the window for the potential for this market to rally all the way to its year highs, but recognizing that there is substantial overhead resistance in this 1275 to 1290 level, it would not be out of question that as the market rallies into 1275, 1290, that it actually begins some sort of a retracement backwards that could see even 30, 40 S&P points back down, and maybe even a week from now we find ourselves literally trading in the same level where we ended this week, and that kind of a scenario certainly could play out. But even if it does, so long as we see no substantial breaks below the 1220, 1210 on the downside, and all the selling is contained to 1-2 days of selling and subsequently stabilization in the markets, then this year-end target, or at least into the first few weeks of January, is a realistic upside target. Next year, I want to take a look at the U.S. dollar index futures, and you can see the U.S. dollar came for a full retest of the previous highs at the 80 level. This could be a double top, but it's way too early to give any indication. In order for the stock market to remain relatively bullish and commodities to remain bullish, it would have to be on the fact that the US dollar is going to stay relatively contained and range bound, like we were suggesting in our intermarket bullet points. Even it doesn't necessarily have to be a bearish US dollar, but more or less a US dollar that trades back down to 76, stays there, rallies back to 78, 79, and 3 months later we find ourselves at the exact same level where we're trading right now. That kind of an environment could allow the stock market and the commodity markets to be relatively bullish, but it would be a substantial break higher of the US dollar above the 80 level, accompanied by a euro breakdown that would throw a wrench into this existing rally in the markets and in commodities. So if anyone wants to remain relatively bullish this market, you're looking for a very range bound to sideways trading US dollar. Next year, when we take a look at copper futures, we drew this wedge on several times. We saw double bottoms and wedges that are breaking downwards that if so long as they're contained could have a very bullish breakout. You're seeing in copper, and that very bullish breakout occurring. This stage, so long as, like we were saying, the US dollar stays in check, copper could strengthen all the way back to 380, 390 on the upside, and then begin potentially far more neutral to slightly bullish trend. Next year, when we take a look at crude oil futures, crude oil created just a little flagging formation on the downside and is already broken bullishly back to retest the 101 to 103 overhead resistance. This is going to be a crucial moment for crude oil and the markets, because if crude oil is able to break to a new high above that 103 level, it would certainly send a message to the markets that they're not that concerned about the currencies nor about a global economic slowness, and that would certainly allow there to be further expansion in the stock market. So we'll be watching for this. If crude oil does make this break above 103 and really gets a push going, we could see a rally even as high as 113, 115, and this would allow a lot of the energy stocks and as well as the global economic cyclical stocks to really participate on the upside. Next year, when we take a look at gold futures, gold has been far more stuck in this kind of horizontal triangle, consolidating, always making lower highs and higher lows as it's been sort of winding up, and we're waiting to see whether or not gold wants to make a committal move higher or lower. Really at this stage, this is winding up that at some point we're going to end up getting some sort of a break higher or lower. It doesn't necessarily mean that that's going to be a new trend, but it's just going to be an observation of which way to have a short-term bias. Really at this stage, so long as US dollar stays relatively range bound, it's quite possible that gold will follow suit and actually also stay range bound. We could see $100 per ounce moves higher and lower, but overall stay completely contained within the highs and low range that we marked off by those focal points. Finally, I want to take a look at the 30-year Treasury bonds, and this is actually going to be one of the most important charts for the equity markets to be watching. Overall, even if you go back to the 2010 Treasury bond rally, it was actually the substantial deterioration of the Treasury bonds over a multi-month period that fueled money rotating in the asset class rotation out of bonds and into the equity markets. And it will be very interesting to see whether or not this ends up being a substantial and major high on the 30-year Treasury bond. Again, there's not enough technical evidence to suggest that we know a double top is in place here, but it would be a deterioration of the Treasury bond markets down towards that 134, 135 market that would be sending some very bullish signals into the equity markets and allow them to really participate on the upside. And so really, and again, any of those that you that want to see the stock market strengthen, it should be naturally accompanied by these Treasury bonds weakening and deteriorating as we see that asset class rotation. If for whatever reason we saw Treasury bonds rally all the way back up to their highs around the 146, 148, that would certainly send a message to the equity markets that they're way ahead of themselves, and it could cause a correction back down to the lows. So again, if you want to be bullish this market, you want to see further deterioration here in the 30-year Treasury bond. That was your Monday Futures Market Outlook. Thank you for joining me.